Hello, everybody. Welcome back. I hope you enjoyed that little break in between and had a chance to check out Mojo's booth. We are now moving into a very, very interesting panel discussion, and it's about the future of fintech, payments, lendings, and savings. And we have some wonderful panelists here today to talk to us about what's going on in that field. And so I'm really excited to hear what they have to say. So the panel will be moderated by Selma Ribica from Ventures 01. And let's see if we can, yes, there she is, Selma, excellent. And then we have Tunde Kihinde from Lydia with us today as well, from Nigeria. We're very happy to have you with us despite all the turbulence there. We have Catherine Muraga from Stanbic Bank Kenya. And we have Aaron Fu from Catalyst Fund. I'm very excited to hear what everybody has to say. Okay, welcome.
Hi, everybody, panelists, listeners, fellow investors, entrepreneurs. I'm really grateful for the opportunity to connect with the community from our bedrooms, kitchens, wardrobes across the world, Tunis, Lagos, Nairobi, etc. My fellow panelists, Catherine, Tunde, Aaron, and I are here today to talk about the future of the fintech industry. Perhaps it's good to start with very short introductions. I'm an ex-M-Pesa executive, founder of a fintech startup in London, and spent last 3 years investing in fintech industry across Africa at seed stage. Catherine, may I pass to you for a short intro, and then Aaron and Tunde?
Thank you, Salma. Catherine Muraga, CIO at Stanbic Bank, passionate about using technology to create business outcomes. Thank you.
Hi, guys. My name is Aaron. I'm the head of growth at the Catalyst Fund. We are an inclusive fintech accelerator that has backed 37 inclusive fintech across the world. I've been living in Africa for the last 6 years and have invested in many early stage companies, and very excited to be here to share a little bit more about fintech and the work that we do.
Hi, everyone. I'm Tunde. I run Lydia, and we help small businesses access credit in one day. So the whole idea is you apply today, money tomorrow. I look forward to talking more about how we serve our SMEs around the world, and a good and engaging discussion.
Thanks, everyone. Fintech continues to be the top hottest vertical for investment in Africa. 2019 was a great year with an estimated 850 million invested in African fintech. And in 1 week in November, we broke the record by only a handful of companies in Nigeria in fintech raising about 400 million. 2020 looked pretty promising in the beginning, and then a Q2 COVID slump hit us. However, given 2 prominent exits this summer, DPO, as well as recent acquisition of Paystack, give us a hint that 2020 will be a good year after all. In spite of the growth investments, the untapped opportunities remain. Combined populations of only 3 countries, Nigeria, Ethiopia, and Egypt, have an estimated 240 million of bankable population, and majority of them remain unbanked. There's an opportunity to offer these customers digital financial identity, remittances, lending, digitizing cash payments, etc. Let's start with COVID and fintech. How do you feel that the spring confinement period have affected the fintech startups in your portfolio and in your surrounding? Perhaps, Aaron, you can start.
Yeah, sure. So I think it's certainly been really interesting times, but I think COVID certainly has not been purely bad news for fintech startups. I think certainly we see a large shift towards digital commerce, and most of our startups that are working to enable SMEs to bring their offerings to digital have benefited. I think a lot of our startups as well that are working in a pure digital format. So I take example of Cowrywise in Nigeria, which is a digital savings app. They've actually seen very, very steady increases in savings and investments in their platform, even during the COVID period. So we really feel that while there are some of our startups that are certainly had a bit of a hit with their own customers having a bit of a hit, I think by and large, the shift towards digital, whether that's from consumer angle or from a business angle, has been pretty beneficial to fintech working in Africa.
Catherine, any comments?
Yes, Salma. Looking at it in terms of, let me tackle it from an adoption and traction perspective. So anyone who is ready, and looking at it from a banking perspective, anyone who was ready to offer payments, lending, savings, any product from a digital perspective, the adoption was certainly high. And anyone who is agile, because even if you are not ready, but were you agile enough to avail some of this capability, we've seen an uptick of digital transactions, either from mobile or internet banking. And also, if you look at it from a Kenyan perspective, looking at an example of the overdraft service provided by Safaricom, Fuliza, I mean, we've seen an uptake of around 245 billion Kenya shillings during this period. Quite impressive.
Impressive indeed. As you said, in majority of the fintechs in my portfolio that are digitizing payments, we witnessed a huge upsurge since cash and in-person transactions were no longer an option. However, from lending business, especially a business serving small and medium businesses, there was quite a fright, and we were all focusing this year on working on and maintaining the existing portfolio. Tunde, would you care offering us a bit of an insight on 2020 for SME lending business?
Sure. Yeah, no, it's been an interesting year, to say the least. And we're quite unique, given that we operate in different markets, and markets that I think the economies don't really have much correlation. So we lend in Nigeria, and then we actually launched in Poland and Czech Republic right at the start of the lockdowns in those countries. And what we saw in Nigeria is very similar to what you said. So we went from, I think we do about 1,500 loans a month to small businesses all across multiple sectors. But of course, once the lockdowns happened, we had to slow lending in the country because a number of our small business customers were not able to operate. But then, interestingly, what we've seen is once the lockdowns ended, not to use a cliche, but we've seen almost a V-shaped recovery. So the SMEs and our lending portfolio has gone back up. So we spent the lockdown period really protecting the portfolio, selectively lending to some sectors that were still open. So we had some telco customers, some folks in grocery, I'd say the mainstay sectors. And now we're seeing a rebound across all sectors. And then in Europe, it was interesting because we're a bit fortunate in that because we launched at the beginning of the lockdown period, we're able to see which sectors were allowed to stay open and support those businesses that saw a big surge in growth. So lots of folks in logistics, lots of folks in agriculture, lots of folks in grocery. And we went from doing roughly about $10,000 a month in our first month of lending in March. And last month we were doing about $1 million. So a big increase for the last few months.
Excellent. Catherine, what about banking? Like, how did you see your portfolio struggling in this period, or harboring the crisis, ideally?
Certainly, one of the things that the regulator, the Central Bank of Kenya, put in is, so both from a payments and a loans perspective. So payments, we saw particular mobile money transactions of up to maybe 1,000 Kenya shillings being zero rated. And as a result of this, we've seen additional new customers now using mobile money channels to the tune of 1.6 million, which is impressive. And from a loans perspective, from commercial banks, we saw around 844 billion Kenya shillings loan restructured. Of course, looking at it in terms of depressed times, courtesy of the season that we are in.
I think this is a nice segue to zoom a little bit more and stay on the lending topic. Collections and restructuring current loan book is a function that every lending business takes very seriously, and especially in COVID times, it took definitely the front seat. Fintech lenders must be closely in touch with their borrowers. We're always looking for signs of delayed payments, reacting quickly to adapt repayment schedules. Once the collection become outsourced to legal companies or collection services, the customer experience go beyond fintech control. Last month, unfortunately, we saw Financial Times and few other reputable media channels write quite damaging articles about collection practices in this industry. What are everybody's views on this type of reputational threat, and how can we manage it better? What are the responsibilities that we can take as investors, as lenders themselves? Who wants to start?
Tunde, please.
I guess since I'm a lender on this panel, I'll take a shot. I think one of the first thing we realize as a digital business is trust is a very big component of your success, right? Because as you're, of course, offering innovative solutions, there's still that question mark with the customer and also with your partners. It sounds good on the cover, but can you, as a provider of financial services, last the test of time? And can you have empathy and provide a good experience to me as a customer? And I think as a partner, we partner a lot with banks and large enterprises. What they will ask is, will you be around in 6 months? And is there anything that you're going to do that affects my brand? And do you have a strong compliance and KYC, etc., that more or less will give me the confidence in partnering with you? Now, so for us, there are a few things that we've done from day one. So a big part of our success has come from partnering with large enterprises. So we work with close to 100 partners across our 3 lending countries, consumer goods companies, payments platforms. And so from day one, we had to have a very strong and robust KYC, compliance, and also assessment, because these brands and these partners are exposing us to their value chain and saying, look, you can lend to these customers so that they can buy more goods or process more payments from me, but you have to be ready for prime time, right? So we invested a lot in the very beginning in our technology, in our backend, in our finance team. We partner with, top accounting firms and lawyers so that everything we're doing from day one is world-class as much as possible. And so far, we've seen 2 things. One is our default rates are historically less than 1%. And as I mentioned with our European growth, it's grown quite astronomically the last few months. I do think, given how fast a lot of these fintech businesses grow, it's inevitable. You will have some challenges and there will be mistakes made along the way. But what tends to happen, what needs to happen is, can you fix those mistakes quickly? Do you take them seriously? And do you put the customer first to rectify any issues that happen? That's my view.
Excellent. Aaron, Catherine?
Yeah, maybe if I can add a little bit quickly to this. I think to build on today's point, I think a lot of small businesses really are looking for fintechs to be more holistic partners. We certainly seen that within our startups as well. We certainly have observed the trend towards embedded fintech, so fintech that really is enabled in a broader offering. So I take the example of Soko Watch in Kenya, whereby the primary partnership is around logistics and being able to manage inventory and being able to get goods at the right price quickly. However, because they're able to provide those services, being able to help their SMEs go through these tough times to hopefully not hit situations whereby the loans will not be repaid, also builds this level of trust and partnership, this sort of symbiotic relationship between a fintech and as well as a small business, whereby it's not adversarial, it's not we're trying to collect and extract as much as possible, whereby it's more about us. We are supporting you in your business growth and helping you recover. right? I think certainly we've seen that in Ghana, for example, where 74% of businesses reported income decrease because of the pandemic. 24% had no emergency funds. So chasing after these small businesses with no emergency funds, I don't think it's a win-win for anybody. But I think if your solution was a little bit more about helping them recover their business, I think there's a lot of opportunity there to build trust and to build a strong and loyal customer base.
Catherine, would you like to comment on this?
Yes, Alma, very, very similar to what Tunde had shared, and also Aaron, centering around trust and also looking at it from what is the impact from a reputational perspective, assessing these entities from what is their posture with regards to, say, data information leakage, what is the knock-on effect from a reputational perspective, what is the impact, can this relationship impact the bank, customer trust? So very similar to what the two have shared.
So very, very, perhaps to continue on this note, let's talk about the dynamic of fintech lenders partnering with banks. Is that a symbiotic relationship or cannibalization or competition relationship? What are the kind of important principles of such partnerships? Perhaps, Catherine, you could offer us a bank's perspective, and then Tunde, I know Lydia has many banking partnerships, maybe a fintech lender perspective.
Good question, Selma. So I look at it in terms of it can be symbiotic, especially if there's synergy in terms of values. So I'll give you an example. Stanbic Bank Kenya being a franchise of Standard Bank, where our purpose is Africa is our home, we drive her growth. So where there's clarity in terms of fintech, synergies in terms of values, is a fintech also eager to drive growth, either from a Kenyan perspective or Africa perspective. So those are key things we look for. And also, how is the team? Are they clear in terms of what needs to be executed? Are they principled? Will they follow through in terms of what they promise? Because a lot of fintechs can come in with all shiny tools, shiny capability, but will they stay till the end and ensure everything has been executed? And certainly, there's a lot to learn from fintechs. If you look at it in terms of the success that we have seen from fintech digital lenders, and posing questions from a banking perspective. Do we need the size of credit departments that we have? Especially if you look at the gains that private capital or fintechs have been able to achieve, courtesy of advancing loans, just using technology, and certainly reducing the cost of advancing credit. So for me, that's how I'd look at it. A lot to learn and symbiotic. If we are clear, there's alignment of values and the teams are principled.
Yeah, no, I think Catherine really mentioned the key points. I mean, there are a few things. So on the, naturally, we view a lot of synergy, because the reality is, given the size of the SME credit gaps in the markets that we go after, Nigeria has estimated anything from $50 billion to $100 billion in the CEE region in Eastern Europe. SME credit gap is estimated to be close to $400 billion, right? This is just SMEs, not consumer, just SMEs. So it lets you know, like, look, to service that size of SME credit gap, it will not be just one player or just one stakeholder. It won't just be the traditional lenders or the banks or alternative finance. And if we partner together, you can really solve a big pain point for SMEs, help to create jobs, and there's also a big profit potential for everyone. So that's for sure. And I think, but the reality is there's tension, right? Because if what the SME is always concerned about is, if I expose how I work too much to a traditional lender, will they try and steal my algorithm and do it themselves? And at the same time, the lender is also the SME is also worried. The SME is also worried, and the lender is also worried that, look, will they take my customer data and share it with my competitors? So there's always some tension. And also, even just when you go down to the different teams, you're going to walk into an SME team in a bank and say, look, I can do this better than you. right? Which can also cause some career risk for some folks in the banks. So how we make sure we explain and position is, look, the loan sizes that we serve, really most banks do not want to do for SMEs. So in Nigeria, we'll go as low as $200 in an SME loan, and the average loan size is about $1,500 to $2,000. And the reality is most banks around the world don't want to do those loans given their existing cost structure. And in Europe, the average loan size is close to $5,000, and it's the same thing. Most banks do not want to do those loans for SMEs. It's just given the complexity. So we say, look, it's a big opportunity to serve your customers who are banking with you, have deposits with you, and offer a new type of product which can help them be stickier with you, help you make some more profit, and also help us to grow. And the reality is, given the pace at which we're growing, so right now we have a processing power of about 5,000 loans a month, and that's going to go from 5,000 to 50,000 to 300,000 SME loans per month. So we say, look, it's better to partner with us so we can capture share together versus just going to a different competitor of yours and then capturing the profit pool. So that's how we think about it.
Excellent. So basically, symbiotic relationship where there's a clear opportunity to segment the market in terms of loan size and offer a lower cost underwriting from a fintech to bank, while bank offering the capital and addressing the new segments together. That's really promising, but what about the flip side? What are some threats of these kind of relationships or things to be cautious about?
I think maybe to speak a bit candidly and maybe to get us started while Tunde and Catherine might think a little bit harder. I think to us, one of the threats, I guess, on the bank side is very often these projects tend to be very personality orientated. So there are specific champions in a large organization that are really, really passionate about this startup working together with the bank in a certain way, whether that's a product head or a business head. And I think one major risk is certainly when that individual either changes position, changes geography, or changes function, that interest in sort of like pushing this partnership through ends up fading away, which is a major risk that we've seen, certainly. And then I think another risk is really on the founder side as well. I think there still aren't enough founders out there with deep experience working in and around banks and really understanding the processes and the structures and sort of like regulatory impact of what it means to work with a larger organization and getting them ready, not just to be able to sell the contract and to get the partnership through the door, but to continue to service as well as like grow the partnership after the POC is complete and after the initial customers have been onboarded. So really making it an embedded part of the bank. So those were sort of two top of mind for me, but I'm sure Tunde and Catherine have much more direct experiences.
Yeah, I could add, and I like what Aaron just mentioned there. I just summarized it as operational risk. So the fintech having the capability not only to ensure they dot all the I's and cross all the T's from the onset, running the proof of concept, but even as the product goes live, just having an eye or a finger on matters to do with operational risk is very important. And it goes back to what I talked about earlier. What is the posture in terms of data security posture, such things? And also another threat I see, and I think Tunde touched on it a bit, is a job threat for existing staff in the bank, especially where the fintech comes with a higher capability in terms of underwriting some of these loans or even just analyzing from an algorithm perspective. And lastly, culture. Fintech tends to be nimble, fast, a lot for banks to learn. We are getting there, but a lot for banks to learn. Yeah.
And when is the right time to introduce compliance department in a fintech startup? Perhaps Tunde, you can offer us an insight.
Yeah, no, really great points by everyone. I mean, so we very early on introduced strong compliance and strong KYC from day one, more or less. And the reason for that was a few things. So one is we are lending with no collateral in fast-growing economies, emerging markets. And so the joke that we give is we've now done about 20,000 loans to SMEs, and I've met 5 of our borrowers, like in person. So you're lending to people that you've never met in your life. And so there's a lot of onus on having really strong assessment, really strong KYC, really strong compliance, so that you can ensure that you're protecting your capital, whether you're using your equity or you're using the capital of your partners. And also, as you get more regulated and you're looking to scale, your regulatory partners and your enterprise partners will want to know, are you ready for prime time? Just like what Catherine was mentioned. So for us, it was from day one. And I think it also offers a great opportunity to really digitize a lot of data that is stuck on paper and in cabinets of traditional lenders. And so it can really be used for deeper insights into the customer, which can then translate into more savings and better pricing.
Thank you. This was a very insightful discussion on partnering and a particular zoom in onto the lending business. Now, moving on to digitizing payments, as we said, this still represents a huge opportunity across the continent. Cash is still the king in Africa, and there's an opportunity to digitize that more so. In light of COVID, we saw the impossibility of using cash and in-person transaction in certain times, and that has only accelerated the adoption. I would like to zoom in quickly on East Africa, where mobile money has been a huge success in terms of adoption and has done part of the job. And would like Catherine and whoever else wants to chip in, kind of describe what other opportunities still remain in terms of digitizing cash, and then move on to contrasting that with West Africa and Nigeria opportunity.
Thanks, Salma. And you hit it on the head. East Africa and certainly Kenya, being home of M-Pesa, we are mobile first. And especially if you look at it from a Kenya perspective, where the mobile phone penetration is slightly over 100%. So even moving away from M-Pesa, every investment from a digitizing payments perspective, you always have to think about mobile phone. And then also, slowly we're seeing the uptake of card going up, certainly looking at it from the statistics from Central Bank of Kenya. So I'd really say around those two, a lot of innovation, and also making sure that even as we drive more around mobile first, how do we make sure the journey is embedded in our lifestyle?
Thank you. Perhaps about West Africa now. Aaron, would you care to comment on West African landscape and opportunity with digital payments?
I think the response is paystack, right? No, but I think certainly West Africa certainly has not seen the penetration of mobile money that East Africa has experienced. I mean, Nigeria is still only about 1.4% of GDP being going through mobile money, whereby Kenya is rated 44% in some surveys. But mobile penetration is still really high. So like, what's really been the barrier? And I think a lot of the barriers have really been sort of institutional, whether they be regulatory barriers or the banks themselves having a lot of control over the mobile money systems and it not being sort of a little bit more free to innovate on, and incentives to open up that platform. So I think the potential for digital payments basis the mobile penetration as well as the ecosystem is really high. But what we've been able to see is a lot of startups in the financial services space get around the common infrastructure, right? So whether that's, again, like maybe going back to Kariwise in Nigeria, they built their own payment wallet for users to kind of top in and top out of, because more money didn't exist and there was no common platform. So I think sometimes while there is a limitation in a common platform, it inspires more people to build interesting things to circumvent that. And I think there's also no surprise why Paystack and Flutterwave and Paga have all come out of Nigeria and not Kenya, right? Because in the toughest of environments, you see solutions that are trying to get around, get more creative. And I think there is sort of a controversial question whereby has the success of M-Pesa actually inhibited some of these potential pay stacks and other ways of coming out of Kenya instead? So I'll leave it there.
And what about beyond Nigeria? What opportunities are there in West Africa?
I think certainly for us, we're very excited about the opportunity in Ghana, right next door, where you really see digital tools being able to be quickly deployed. We see a lot of regulatory frameworks there which are emerging, which are very favorable to digital commerce as well as to fintech. The central bank there has been really supportive in setting up sandboxes and sort of safe environments for startups to be able to innovate. And that's sort of a very big reason for Catalyst Fund setting up a new facility in Ghana in partnership with the MasterCard Foundation to drive digital commerce, because we think that now is the right time with all those building blocks and elements in place to be able to continue to drive digital commerce through fintech in Ghana.
Excellent, very exciting times. Congratulations on that. Perhaps it's a time to look into the future and talk about exits. Paystack, is that an outlier? What are banks and private equity firms looking for when acquiring fintech opportunities? How do we see COVID crisis affect the future prospects of the industry? Please volunteer, whoever wants to chip in first.
So I'll kick off. I mean, yeah, no. So Aaron mentioned it. I mean, where I think the entire ecosystem celebrated the Paystack deal. So we're proud of that team, and we're really excited that they were able to partner with such a great business in Stripe. I think it just shows the potential for the continent. And we're seeing, I think, a few things. So one is, it's clear the whole world realizes Africa is the last frontier, right? And the beauty of the continent is it's a pretty blank slate when it comes to a number of services, so e-commerce, financial services, and you're not held back by a lot of the legacy issues you have in the West, where, look, you have an existing physical infrastructure, an existing tech software infrastructure, and even though you want to innovate, it's tough to unwind all that overnight and give the customer what they want today. Whereas the beauty of Africa is, if you were thinking of building the XYZ of the future, asset manager, bank, lender, payments company, you can really start from scratch and build what the customer wants now. And I think that's why you're seeing such fantastic businesses emerge from Nigeria and across the continent. And I think what seems to be happening, the trend is, you look at Paystack with Stripe, you look at Visa and InterSwitch, is these large brands are saying, look, this is such a particular continent with 54 different jurisdictions and currencies. I want to win this market, but I need to invest in local teams to help me win this market. And so you back the biggest and best players in your particular sphere and say, look, we will give you the balance sheet and the support you need. Now you go and use your local expertise to make it happen. And what's also interesting at the same time is you're also seeing the customer, because of the mobile phone and access to so much information, they are becoming increasingly aware of the type of financial services they need, whether it comes to insurance, whether it comes to lending, whether it comes to payments, and they are demanding these services, and they are more open to using fintech and technology to access these services. And they also, I guess we all realize that if you are tempted to go a brick and mortar route, it will take you 100 years to build out bank branches or payment centers across these countries. So clearly technology is first. So it's a testament that the opportunity is real and it's now. It's now up to us to show we can have repeated successes like the Paystacks and InterSwitch to make it a reality.
So I agree fully with what Tunde was saying. I see huge opportunities for partnerships, certainly with banks and fintechs, especially where there's alignment of values. One thing fintechs do very well is they provide frictionless customer journeys, and also they provide opportunities for scale. So where banks are really keen on growing their share of wallet in terms of scale and providing client-centered or individualized customer engagements, huge opportunities for partnership.
Aaron.
Yeah, I think maybe one thing that maybe gets overlooked a little bit of the Paystack deal is also they were able to exit at 200 million after having only raised 10 million, right? And I think if you think about the number of companies out there that are in a similar kind of fintech space that have raised significantly more than that, hopefully it correlates to sort of more of that too coming through. I think what the deal has also done is really put Africa on the map for potential other buyers across the world to look at more seriously when it comes to these full acquisitions. Because I think in the past, reliance has really been on local enterprises and local corporates to be sort of trade sale partners. And so whether that's DPO that you mentioned as well, Selma, like a lot of these buyers coming from outside Africa seem to have significantly more liquidity to be able to make these larger deals happen. I was just chatting with someone else a little bit earlier about Flutterwave. I mean, thinking about their most recent funding round, like Flutterwave, pretty much needs to exit at about 400 million, if not $500 million, in order to make that interesting. So question is, in the global markets, who is actually willing to pay $500 million for that business? And hopefully with Stripe coming in and shouting about what they've done, we will see more of that come through. But of course, that also means that the startups in Africa are now going to have the engineering and capital backing them that potentially could exceed some of the local banks in Africa as well. So I wonder what that will do to partnership dynamics too. But anyway, Thelma.
What about local buyers? What are local buyers looking for? This is really a prominent acquisition where we have Stripe, we have a strategic from US acquiring a local company. But I think majority of the acquisitions and exits in this industry, at least for the time being, will be coming from local buyers. What are your views on what are the local buyers looking for, and what price ranges we can be expecting here?
I mean, would love to hear from Catherine, seeing as how Standard Bank has really been sort of leading in terms of acquisitions like SnapScan and things like that they've been able to do and really work together with startups. So for example, they've made a strategic investment in a Catalyst Fund portfolio company, Mobilife, in bank assurance in South Africa. So we'd love to hear her perspective. I think one of the biggest challenges and sort of like mismatches between local corporates driving acquisition as well as having international investors on the cap table of some of these companies is just from an expectation of price that seems to be like really, really off in terms of what local corporates have been willing to pay so far. But I don't know, I wonder if anyone else can shed more light.
Tunde, Catherine.
Now that Aaron has mentioned my name, I'll touch on it briefly. So from a banking perspective, a lot to learn in terms of even just transforming our minds. How do we work with fintechs? What's a framework? And tying it back to what I said earlier, values. What is the alignment of values? What value do we get out of this? How does it speak to being client-centered and also driving scale, both from a country and a continent perspective? I think those are the key parameters. Tunde?
Yeah, and I mean, so I was an M&A banker a very long time ago, and I think a number of times you're trying to understand, look, do I build it myself or do I buy it? And I think that's a discussion that's happening a lot internally to understand, look, do I have the team that can actually deliver what I believe I will need to take my business to the next level? And I think the next consideration, or two considerations, will be the currency, right, that they use. And what I mean by that is, in a number of cases, if you're a public entity looking to make an acquisition, you also have to be fair, look at how the stock prices for a number of these local players. I would imagine they would argue that they feel like they're undervalued, right? And so, do you have the currency that you need to actually be bold and make an acquisition, and have that acquisition as you see it benefit your stock price down the line? And I think the third thing I would say is a number of these regulated entities have capital requirements, right? And so, and I think depending on what you're buying and how you're buying it, those acquisitions can have a negative effect on your either tier 1 or tier 2 capital, right? So you have to then also make that judgment call. Look, if this is going to be a hit to my capital, is it really worth it to me do I really believe enough to take that hit, right? So I think there are a number of considerations, but it's clear that there's a race for market share as the customer becomes more digital. And I think these increasing exits will begin to force tougher discussions at the board level to say, look, can we wait? Or do we have to make a move now so that we maintain our market share?
I think it's important to balance out, I believe as a founder, it's important to balance out the strategy of the company, the future growth, and the wants of various investors on your cap table that sit around the board, they sit on the board and participate in these discussions. While on the other hand, we have local buyers and private equity looking for attractive prices, and only few strategics willing to, mention the sums, large sums like 200 million for acquisitions in Africa. Well, thank you very much for this. This was an extremely insightful session. Allow me to conclude. I believe 2020 has been a very challenging year in particularly for SME lending business, and from the point of view of fundraising, there were many fintech startups caught up in the middle of starting fundraising in the middle of the crisis, and things needed to be delayed. However, overall, COVID-19 crisis has been a blessing in disguise as it accelerated adoption of digital payments, and on the other hand, even pushed regulators to think about fintech as an alternative to keep the economy going, pushing forward some positive regulation for electronic KYC, fintech lending, and other types of licenses. Therefore, I think we're looking to an interesting future where banks and strategics will keep on acquiring in the sector. Thank you, everybody. Stay healthy and stay in touch.